Hey, Eric, are you interviewing me today, buddy?
Yeah, let's do it, Dale.
All right. Well, I noticed you're doing it, and I think it's smart. And let me, before we get to what you're going to talk about today, and you could share your screen, don't you find that during that process, and you're interviewing smart guys, that you are better because of the intelligence gathering from other people whose work you respect?
Oh, without question. I mean, even if you have similar views, different views, just hearing it
Yeah,
explained in a different way
yeah,
sometimes hits the audience. Some people you resonate with some, styles of analysis more than others. So
yeah.
I think it's helpful for everybody.
Yeah, so I'm on your I get your emails, and I've noticed some of the people that you've been talking to, and I'm wondering what's the most important relevant piece of information you've gathered through interviewing people over the last 30 days, and then we'll get to your work, and maybe I find that a lot of that confirms what I'm thinking coming from a different angle, which almost gives it confluence. Does that
Yeah.
happen in fundamentals too?
Yeah, I think that the biggest thing for me when I speak to different people or anybody in the macro space is it's everything's really time frame dependent. You kind of have to get that on the table first, because one of the biggest issues we've seen this year is the concept of transitory, right? And
Yeah,
that issue's been uh, very confusing because there's really no definition of transitory. Is it six
everything
months? Is
is.
it 12 months? Is it 24 months?
Yeah,
It really depends. If you're trading or investing in, say, 30-year bonds, 1 year of inflation really doesn't matter all that much. 2 years of inflation doesn't really matter all that much. So you really kind of have to get on the same page with what time frame you're talking about. Are you
yeah.
in are you in cyclical trends? Are you looking at secular trends? Are you looking at what the world's going to look like 10 years from now? All of that really is totally different depending on who you
Well,
speak to.
you were one of the first economists that I interviewed that started talking about slowdown in the economy. When we got the consumer confidence number on Friday, um, were you thinking that that is validation of what you were thought? Is it happening faster? Do you think it'll show up in retail sales during the holiday season?
Yeah, so it is in line with what I'm thinking. I take a very, very data-driven approach. I don't use any anecdotes and I don't cherry pick either. So while the consumer confidence numbers did support the view that I have, the consumer confidence data is not an input in any of my indicators in any of my models. I've never
Why?
found too much statistical relevance to the consumer confidence data. It tends to be, at least until the last few months, a barometer of stock market performance. So when the market goes up,
I
consumer
see.
confidence goes up. That's changed, and over the past couple of years, the other interesting thing about that data is it's become increasingly political. There
Okay.
are
What hasn't?
subcomponents. Right,
Yeah.
exactly. There are actually subcomponents of that consumer confidence data that breaks it down into Republican respondents and Democrat respondents. And whoever's in office, the other side has terrible confidence, and as you might
Yeah. I
expect.
get interesting.
But
Okay. So
on
it's
the
more
on the
like the
retails,
whims. It's more like the whims and
yeah,
opinions, and
exactly.
really doesn't exactly reflect their behavior with their
Exactly.
wallets and purses.
Yeah, exactly. And
Okay.
one comment I had on the retail sales data, and then I'd love to rip through some slides that I
Yeah.
brought to sort of explain my view, is we have to at least be aware of what data is reported in nominal terms and what data is reported in real terms. So retail sales is reported in nominal terms. That's inclusive of inflation. So if we look at the consensus forecast for the report tomorrow, retail sales are expected to increase 1.0% for the month. But if we remember last week, the consumer price index rose 0.9% for the month of October. So what that means is real retail sales
It's
are
point
only
one.
expected to increase 0.1, which
Wow.
you annualize that, that's about 1.2%. So real consumption in real terms has already declined pretty significantly. So that's an important thing to remember as we look at some of this data. If you'd like me to go through, I can maybe.
No, I would.
I would like.
Because
I
I
could.
just, I didn't even know that in retail sales.
Yeah.
I assumed, because, if it doesn't have a candlestick, I don't know what to do with it. But, I think that's very interesting. So we're going to have, maybe over the course of the next 6 months, retail sales looking better than they really are because of the inflation component.
Exactly right. So with
Yeah.
with that said, I could probably rip through this in maybe a couple of minutes, and then we can.
Go
I'll
ahead.
try. I'm going to hit on growth, inflation, kind of everything I can. So
I get the hint, Derek. I'll shut
every
up.
time I show up, I bring the same couple of slides. People may get upset, but it's a very consistent framework.
They
What
don't
we're looking
remember.
at here is industrial production, non-farm payrolls, real consumption, and real income. This is all in real terms. And what we're trying to look at here is what I call the four corners of the economy. So,
Like it.
it's not specific to one sector because we're trying to look at broad movements across the entire economy. And what's important here is the direction of growth, not necessarily the growth rate itself, but what's the momentum? Where is it moving? Is it accelerating or decelerating? That's the most important point in economics, in markets. It's all rate of change. One way that I would explain it is if I said, Dale, you're going to be moving at 100 miles an hour. Is that
Yeah.
fast or slow? Well, you
Yeah.
really can't say, because if you're in a car, that's probably quite fast. But if you're in an airplane, you'd be probably going down, right?
Yeah.
So
Right.
it totally depends where you're coming from. And what we can see here is that all economic data, whether it's production, employment, income, consumption, all increased throughout the beginning of the year. And right around March of 2021, every data point basically peaked in growth rate terms. And that's not a base effect because this isn't a year over year calculation. And it's not an anomaly because it's across all four corners of the economy. So what we can do is we can smush these four indicators into one and sort of get a real-time barometer of what's going on. Again, we can see that the growth rate increased throughout the beginning of the year. We had a very definitive peak in March 2021, and the growth rate of the economy in real terms has been declining every month since. Why is that important? That's important because if we look at bond yields, when did the long-term bond yields peak? March of 2021. Everything is correlated to the direction of growth. If we look at the yield curve, peaked in March 2021 because everything's correlated to the direction. If we look at the stock market, we have to sort of look at the stock market in relative terms because we have to sort of net out inflation. So if we look at the relative performance of the Russell 2000 to long-term bonds, everyone, is very afraid of bonds. Nobody likes bonds. March 2021, Russell to bond peaked. So despite this crazy inflation that we've been having, you would have been better off sticking your money in 30-year long duration treasury bonds by quite a margin than a cyclical index like the Russell 2000. And what may be more relevant for this audience is what happened to currencies. I like to look at what I call cyclical or commodity sensitive currencies. This is a median basket of the Aussie and the Canadian dollar, peaked in April 2021, and that's been declining since. All of this is extremely consistent with an acceleration in growth that happened in the beginning of the year, a peak in growth that happened in March 2021, and then a subsequent decline. So then the real question is, where does growth go from here? That's going to determine the next 6 to 12 months of all of these major asset classes, and we can get into that. But before that, some comments on inflation. Inflation, obviously, extremely elevated, 7% based on the way I measure it, 5.3% based on core. And what's been driving it? A lot of people are looking at rent and a lot of people are looking at other components. The real big driver here is durable goods. Durable goods inflation is really driving the bulk of the move in inflation, even though it's a smaller portion of the CPI basket. Everyone loves to focus on rent because it's 30%, 33%, and it's very important. I'm not trying to dismiss that. but we also have to look at the volatility of these components also. So durable goods, while it's 10%, rose from 0 to 20, while CPI is 30%, rose from 1 to 3. So durables is having the outsized impact. And we have to say, okay, well, why is that happening? Because we had a major spike in durables consumption. This chart shows nominal income. So this is including inflation, including all of the stimulus payments, including everything, every single bit of income in the economy. And if you look at the trend line since 2000, inclusive of the stimulus payments, we're right back on the same trend line as we were before. But if you look at the blue line, durables consumption increased so massively, we basically pulled forward 7 years worth of durable goods consumption in a year. And this was a global phenomenon, which is
That's a
why
lot. That's
that's a lot.
huge.
So,
That's a, yeah.
a point that I like to bring up is, was this really QE related? Was this really stimulus related? You can't say fully because income is no higher than it was, but durables are a lot higher. So it was really a behavioral change. It was locking people inside. You can't consume services. You can only consume durables. People moving from cities to suburbs. Now you have to furnish your home with furniture and ovens and microwaves and refrigerators. All of that is durable consumption that requires manufacturing and shipping. So that's where the logjam is happening. And it was more of a behavioral shift versus an income shift. Income totally contributed to it. Not saying that the stimulus was not a factor, but it was definitely more of a behavioral impact.
Getting a question from Paul, what's the good PPE?
The goods PPE?
Yeah, I don't know what he's really talking about.
If he's, goods inflation is was on this chart here was 15% over the past 6 months. I'm not sure if it's relating to the inflation, but the goods component is the one that's driving the inflation because of such a massive pull forward. This is about 7 years worth of goods consumption, but you do see that we are.
Has this ever happened before?
Oh, no, not even close. And we do see that the goods component is falling now, and we would expect that to normalize. And as that normalizes, then the inflation rate should come down. But this is going to take some time to work off here. So
what if personal income breaks the uptrend line?
Well, I'm going to get to that on my next slide.
Oh, okay.
So here
there
we have real income. So why is this inflation mattering? This inflation matters because all of the income that people are getting is not making up for the inflation. This is not a wage spiral. This is not, the economy's so good, so inflation's picking up. What's happening here is we artificially shifted consumption to durable goods. It broke supply chains. Goods inflation's rising out of control as a result. And what that's doing is it's eating into people's real income. This chart is real disposable income per capita. Again, this includes all of the stimulus payments that were sent out. You can see it in these big spikes here at the end of the chart. These are all the stimulus and bills that were sent out. Inclusive of all of that, if you go back to 2009, we're below that trend line in real terms, which means that over the last 12 years, no matter what they've thrown the kitchen sink at it, real incomes have not increased more than 1.8%. on an annualized basis. If you exclude the transfer payments and you look at just what is the real economy generating in terms of income, you could see the trend line from 2009 to 2020, and you could see this glaring hole in real incomes. And why is this all important? This is going to be my last slide. It's because if you look at real GDP per capita, this is the closest proxy to what we call the standard of living. It was a horrible trend before COVID, only increasing at about 1.6%. And we've thrown about $5.7 trillion worth of borrowed funds at this problem. And what have we got for it? A trend that's lower than we were before. And this is a result of unproductive debt burdens and declining demographics broadly. So that's sort of my quick take on the state of the economy as it is right now.
Great narrative. I wanted to ask you, when you're talking about durables, the agricultural commodities are not durables, right? I mean, the Fed can't print corn.
That's right.
Or beans or coffee or cotton. You look at almost any commodity chart across the board, and we're at meats, everything, at levels that are at historic highs. And I don't think that even higher interest rates or recession drive those prices down. I saw this in, the Volcker era. Um, what's the Fed going to do here with what's happening with wages? Do you really think they're going to lean into and continue to taper and possibly tighten with everything you just talked about?
Well, I certainly think that they're going to try because politically, with
Yeah,
inflation running at
politically,
six, seven,
what
six,
about
7%,
economics?
it's very difficult for them to
Yeah,
sit there and sort of take the criticism. So I think they're going to try, and they're going to try with as baby steps as they can, start just by reducing quantitative easing. But the market is forcing their hand. And what I mean by that is they're lifting short-term rates pretty
yeah,
aggressively. And we're actually pricing in a rate hike as early as June of 2022, which is cutting against the Fed's guidance. The Fed wants a very slow and methodical tapering process that they've outlined is going to, consensus believes it's going to end around June, July of 2022. And the market's saying that they're going to have to hike rates simultaneously as the program's ending, which is not what the Fed wants. They want to unwind the program, wait for a little bit, see how things react, then start to raise rates. And the market's saying, no, you have to raise rates now. And what that's doing is, going back to this chart, is it's causing a massive flattening of the yield curve, because the long-term rates, the ones that are sensitive to what goes on over the next 10 or 15 years, are saying you could raise rates, in the here and now to combat inflation, but the economy is too structurally weak and you're going to have to lower them again. And that's the main problem here, is that they can't tighten conditions without flattening and possibly inverting the yield curve. So this chart here shows real GDP per capita. It's the trend line. That delta between the red line and the purple line is a deflationary or a disinflationary gap that's building, and ultimately consumers are going to reduce their purchases of luxury goods and investment in order to try and gain back the standard of living trend that they were on. The Fed tightening into that is going to end sooner than the market expects.
okay. So it may be not even get to tightening. But anyway, I think that's what Dalio is saying, that they'll begin to taper and then reverse it before they even get to tightening. So, translate what you're seeing, and people say, well, Eric, God, should I be in the market? What should I do? Should I sit in cash? Are bonds still a good place to be in this type of environment? I know that you don't recommend trades, but do you have themes for how people should invest during a economic period like this?
Yeah. So the way that I approach the world is I always come at the situation with a balanced portfolio framework. I personally like Dalio's all-weather framework as a baseline. It's got stocks, bonds, gold, and commodities all
Yeah,
balanced in a way that, whatever happens, you have some asset that's weighted appropriately, that's going to perform well. And then
yeah,
from that balanced framework, I look at these trends that I just outlined and said, okay, well, based on what's going to happen over the next 6 to 18 months, which assets are likely to perform better than the other ones. So, given my outlook that the economic growth rate is going to continue to decline, what you'd want to overweight in that scenario is the long-term bonds, despite how
okay.
hated they are. You'd want to, I believe, you'd want
They
to
do look lousy right now, though, Eric.
you. Well, there's been quite a move since.
Yeah,
What do we have here? Since there's been about 20% gain since that
yeah,
March low. So there's been a
yeah.
pretty good move in the long rates. I would be underweighting the commodity complex as a long-term investment, unless you
Interesting.
have some sort of trend following strategy. There's obviously a lot of momentum that's going on in the commodity space. It's all supply chain driven, but lumber being the poster child, there's a lot of China-centric commodities that are showing the same pattern, where once these bottlenecks clear, there's a pretty quick trap door that goes down 30, 40, 50%. Those trap doors are in line with the economic conditions. I don't have a way to tell you which month that the bottlenecks will ease, but if you're playing the commodity space, I would be very mindful of a trend following strategy, which when the momentum breaks, you are going to be against the economic trends. As far as gold, I'd have a pretty neutral weight to gold. And my equity exposure, I'm not, crazy underweight equities. I have a small underweight position in equities, but my equity allocation is tilted towards what I would call defensive equities, which is more growth sensitive. So it's counterintuitive, but when the growth rate in the economy declines, growth becomes more scarce. And then companies that have actual growth trade at a premium, which is why whenever the growth rate in the economy is declining, you see a resurgence of the big tech companies as the outperformers, because they actually have legitimate 10, 20% growth. And when the growth rate goes down, that growth trades at a premium because it's harder to find.
Okay, so not staples. Staples would be an avoid for you.
It all depends on the company itself. Long stable cash flow. So the reason that the tech companies really enjoy that benefit is because they're perceived to have durable cash flows as far as the eye can see that are non-cyclical. So market participants believe if the economy goes into a recession, the cash flows of the big 5 tech companies are going to be relatively unchanged. And therefore, if the economy declines, interest rates go down, and their cash flows remain stable, they should be discounted at a higher multiple. So
your take on the biggest driver of inflation, oil, energy?
Durable goods inflation. Energy would be a second component. And if you think that the 7% inflation is going to continue into next year, like if we go into November 2022, let's say, if you believe that inflation is going to stick at 7%, we basically need another doubling of the energy commodities, which is unlikely in my opinion.
Okay. You're talking about what, 160 super spike. Yeah,
exactly. And one last point I'd like to make, I know you guys were talking about the dollar. I have a couple of charts here. This is the my preferred measure of the dollar because the dollar index is very heavily weighted towards the euro. Despite the QE, despite the narratives, since 2006, the dollar's up more than about 15%. This is broad. This includes many currencies. I think 20 plus currencies. And if you look at emerging markets, this is the dollar against the emerging market basket. We're up over 25% since 2006. So we have to really check this narrative that QE and fiscal spending and deficits are going to ruin the dollar. There are probably other factors at work that are causing this secular trend. I'm a long-term dollar bull. I've been saying that since I've been on your show for the last couple of years, because the drivers of the currencies are the growth rates in the economy. And as poor as the trends in the US are, they're still the best trends in the global economy. It's the safe haven currency of the world. The other major economies, Europe, Japan, China, and the United Kingdom, all have worse structural trends, worse demographics, and worse aggregate debt levels. That means that over the long term, their economies will not be able to handle higher real interest rates. So as bad as the US real interest rates are, we'll still be able to support the highest real interest rates relative to those other economies, and therefore our currency will hold the bid.
Okay. Wouldn't the dollar being a sacrificial lamb be kind of a solution and visible out for a recession?
Well, are you speaking in terms of like inflating away the debt, inflating away the burden? Is that sort of
just
the
debasing
premise?
it, where you'd have nominal gains in assets based on a weak dollar, and maybe inflation, like you're saying, isn't the issue, and a weaker dollar could be a sacrificial lamb, kind of bail out third world countries that could tip us into a financial crisis, all their debt being denominated in dollars. That could be a spillover for risk here, that if we had a weaker dollar eventually, that would alleviate it.
Right. So the currencies are all relative. And the one thing about major currencies of the world, so you look at the 5 major currencies, is they all spark retaliation. So if the US currency starts to depreciate, that means that the euro is going to rise, the yen's going to rise, and that's going to put their economies into a recession pretty quickly, which means that their central banks are going to come back and try and out ease The
Yeah,
US.
beggar thy neighbor.
Exactly. So if you're a small country, a peripheral country that's very, very limited in terms of the global economic impact, you can devalue your currency by 50% and no one's going to retaliate because no one really cares. The US is not going to be able to devalue their currency. Mechanically, there aren't too many ways that they can do that. But even if they were, it'll spark immediate retaliation. The second point is that if our goal here is to inflate asset prices and that's going to help the economy, we have pretty good evidence over the last 15 years that asset prices have skyrocketed, but the economy has performed quite weak, as I showed in that chart. And that's because the concentration of assets is very, very limited to few households. And we have great peer-reviewed research on the wealth effect, and the results are that it's negligible. The second point that I would make that everyone likes to say is we're going to inflate away our debt. If we look at what's called the fiscal gap, which is all of our future debt burden, it's basically all Social Security, Medicare, Medicaid, and various types of transfer payments. That makes up the vast lion's share of the future debt burden. All of that debt burden is implicitly or explicitly linked to inflation. So you can't inflate your way out of an inflation-linked burden. A good example of that would be everyone has seen Social Security payments increased by 5.9% because inflation was 6%. That all that means is that next year's spending is going to be 6% higher. So you can run the CPI at 7% for the next 10 years if you really want to. All that's going to make you is your spending is going to compound just as fast as the inflation is because we've linked all of our burdens to inflation.
Okay. Do you think that people could beat inflation by substituting meat and barbecuing flat screen TVs?
No, and that's the problem, is that there's really no way out of a deterioration in people's real incomes.
Yeah.
And ultimately we will ultimately see that in the consumer numbers, whether it's in this month or in the months to come, is that people will try and gain back their standard of living that's been lost. And this chart shows the erosion of the standard. I mean, 1.6% was a brutal trend to begin with. It was over 2% before. Now we keep resetting to a lower and lower trend every time the economy has a blip because we paper over the problems with excess debt. All of that debt's unproductive. It's not printing money, it's debt.
Could we ever retest that 2020 spike low?
I don't foresee that unless we have other lockdowns. But if you look at other countries that are further along this debt burden and demographic track, like Italy, for example,
they've pulled back into it.
Their real GDP per capita is actually lower than it was in 2007. Wow. So they've made no progress in the last 13, 14 years.
That's Italy?
Italy.
How about Greece?
I haven't looked, but I believe they're basically the same. Japan is another one. All the countries that are further along the demographic track, and these are charts on demographics. I don't want to run out, but we all have aging populations. This is the share of 65 and older. When the line's going down, the population's getting older. It's not just Japan. It's not just the United States. It's Europe, it's the United Kingdom, it's China. And why is that important? Because if you correlate real growth and aging demographics, there's a pretty tight correlation, and that red dot shows where we'll be in the 2030s. So we have quite a singular force to battle against, and our goal right now is to use debt to try and artificially stimulate our way out of a secular decline, and all that's doing is adding more debt on top of an existing debt burden.
So there's your answer why Joe Biden wants elder care.
Yeah, it's not going to work. Yeah, exactly.
Yeah. And anyway, wow. What a bunch of altacockers, which is Yiddish. I'm not going to translate it. So anyway, Eric, great insights again, and learn from you every time you're here. It's amazing. I've interviewed many economists, and you're light years ahead of people that have been around decades longer than you. So really appreciate you being in our rotation.
No, I appreciate you reaching out, and this has been great. I got introduced to Blake, so this has been wonderful for me as well.
Yeah. So keep up the great work, and I'll get in touch with you, and we'll set up another date when we're further along the road of your narrative.
All right. I look forward to it.
Okay. Everyone, that's Eric, and the best place for them to follow you, Eric, is on Twitter and at your website. There's take a screenshot so you know where to reach Eric. Go to his YouTube videos. That's where you have all your interviews and your own stuff. He writes for Seeking Alpha. Thank you very much, Eric. I appreciate your views, and
Thank
that
you, Dale.
that you share it with people.
Yeah, you know? I love it, and I really appreciate you giving me a chance to share my views. So thank you, and look forward to it again.
You're welcome. Well deserved. And that's a wrap, everyone. You could join the team in 13 minutes in the Morning Edge. And remember, don't just count your economic indicators, count your blessings. And I'll see everyone for Turnaround Tuesday. Adios, everyone. See you, Eric. Thanks again, man.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.